Greetings from the team here at Heritage. I thought it might be a good idea to check in with you after last week's Fed meeting and then the ensuing market volatility that we experienced. The Fed came out with their plan for the remainder of this year, and of course that can change, but they are planning on continuing to raise interest rates throughout the remainder of the year to try to fight inflation. And at this point, the Fed has to take action. It's critical that they do something to try to head off inflation. And someone asked me, why would they raise interest rates if they're trying to reduce inflation that is now at a 40-year high? And that's a very good question. What they do by raising interest rates is they make the cost of money more expensive. Let's take housing, for example. So right now we've seen this tremendous housing boom over the last couple years, and a lot of that has been driven by low interest rates. And just this year alone, interest rates on mortgages have about doubled. What that will do is it makes homes more expensive and should slow down home sales and also this price appreciation. And what we'll see is as money becomes more expensive for consumers and for companies, is that should begin to slow down demand and begin to slow down the economy, which then will head off inflation. If we remember, inflation is just simple, more demand than supply. And if we go back to 2019, we can remember at the beginning of COVID, the supply disruptions that we experienced with China, our major trading partner. And since then, we've had global supply chain issues. We've had, obviously now with Russia invasion Ukraine, we've got issues there with energy, so we've got energy inflation, and we've got to do things to slow the economy. Currently, we have equity markets down about 20% from their highs at the end of last year. And just to give you a little perspective, is this normal? Well, the last time that the Fed went through a tightening cycle started in the beginning of 2016, went through the end of 2018. The Fed raised rates over those 3 years 9 times, about 2.5%, and that culminated in a 20% drop in equity markets. So it's interesting how history doesn't repeat itself, but it oftentimes rhymes. Now, even though 2018 we saw a 20% correction in the markets, then in 2019, as the Fed stabilized and didn't raise interest rates anymore, and actually even reduced rates a couple times, the market in 2019 shot up 30%. So we can't predict what's going to happen. We plan for times like this. We know that we're going to have times like this, just investing in equities. But the reason we invest in equities is even with the 2018 20% drop, followed by the 2020 34% drop in the equity markets, and now this 20% drop. If we go back to the highs that we experienced in the markets in 2018 to where we are at these current depressed levels, the S&P 500, which is a measure of the 500 largest U.S. stocks, is still up almost 40%. So in spite of these 3 corrections, more than corrections, these bear markets, we have are still up by almost 40%. And that's what we have to remember as we go through periods like this, is we have to manage our emotions. When we invest in stocks, we know we're going to experience these times. They're never fun. It's much more fun when we get our account statement each month and the account values are going up, but we know that we're going to have these. It's part of the planning process. So it comes back to we have to not panic. And I did want to mention, not this past Saturday, but 2 Saturdays ago, the Berkshire Hathaway annual meeting, and of course Warren Buffett is there leading it, even at 91 years old, just extolling his wisdom to all of us. But I listened to 3+ hours of that, and he had a couple of comments that I thought were really telling for the man that has to be the most successful investor of our lifetime. Made a comment that Berkshire's success is more about being sane than being smart. So what is Berkshire doing during these time periods? Well, the last few weeks, going back into April, they have actually spent over $50 billion, that's with a B, buying great American businesses, as he says. And they're not selling. So while we have tens of thousands, hundreds, maybe millions of investors selling out of the markets, what is Warren Buffett doing but buying? And he says that it's times like these that create these opportunities that make them great long-term investors. So I want to be careful not to run on too long, and if you read the attached article that I sent with this, you can get more details on really what I'm thinking. But I wanted to just summarize, these last 2.5 years have been some of the most volatile times that I've experienced during my adult life. If you just think back to the end of 2019, what we have been through, not just as a nation, but as a world. And I think we're just all exhausted. And I think that's why this time, this correction, this almost 20% bear market, it just feels that much worse because the negative news just keeps piling on. But remember, we too shall work through this, and I can actually paint a fairly bullish case for the U.S. economy. So it's not all negative. So let's be patient, let's stick with our plan. And I'd love to talk to you in more detail if you'd like to talk further on this. But again, if you'd like, read through the attached article. It has more details. But otherwise, please take care of yourself. Please take care of loved ones. I don't think we're completely over all this COVID time period. So anyways, take care of yourself, and we'll talk soon. Bye-bye.